Yo, ever wondered how the big dogs in Forex keep wrangling those pips? It's like they're always one step ahead, right? How they sniff out a weak currency like a bloodhound on a scent? It's almost like they have a sixth sense for this stuff. Well, strap in because we're about to crack open the vault on economic indicators, the secret sauce of Forex trading. These indicators are the bread and butter for any serious trader. Think of it like this. Economic indicators are like the vital signs of a country's economy. Just like a doctor checks your pulse and blood pressure, traders check these indicators to gauge economic health. They give you the lowdown on whether things are looking healthy or headed for a dumpster fire. Are we talking growth or recession? Boom or bust? Now you might be thinking economics, snooze fest, but hold up, don't tune out just yet. But trust me, this stuff is way more exciting than watching paint dry. It's like having a crystal ball that shows you where the market is headed. It's all about understanding the forces that make currencies rise and fall, the push and pull of supply and demand, interest rates and geopolitical events, and how to use that knowledge to make some sweet trading decisions. Imagine being able to predict market movements and capitalize on them. So put on your learning caps, grab a snack, and get ready to level up your Forex game. We're diving deep into the world of economic indicators, and by the end of this, you'll be trading like a pro. From GDP reports to employment numbers, inflation rates to consumer confidence, we'll cover it all. Each indicator tells a story, and together, they paint a picture of economic health. So stay tuned, because understanding these indicators is your ticket to mastering the Forex market. Let's get started. First up, we've got the big kahuna, the heavyweight champ of economic indicators, gross domestic product, or GDP for short. This is the granddaddy of all economic metrics, the one that everyone keeps an eye on. Think of GDP as the total value of all the goods and services a country produces in a given period. It's like adding up the price tags on everything from cars to cornflakes, from haircuts to houses. Basically, it's a measure of how much moolah a country is raking in. When you hear that a country's GDP is growing, it means more money is flowing through the economy, more jobs are being created, and businesses are thriving. A strong, growing GDP is like a shot of adrenaline for a currency. It signals to the world that the economy is healthy and robust, which in turn boosts investor confidence. It gets investors hyped, attracts foreign capital, and sends the currency soaring like a rocket. Foreign investors are always on the lookout for strong economies to invest in, and a rising GDP is like a beacon for them. On the flip side, a weak or shrinking GDP is like a punch to the gut. It indicates that the economy is struggling, businesses are closing, and unemployment is rising. It makes investors nervous, sends capital running for the hills, and can leave a currency down for the count. Investors start pulling their money out, looking for safer havens, and the currency takes a hit. So yeah, GDP is kind of a big deal in the Forex ring. It's the ultimate indicator of economic health, and traders around the world watch it like hawks. Whether it's rising or falling, GDP movements can have a massive impact on currency values and investment decisions. Next up, we've got the unemployment rate, which tells you how many people are out of work and pounding the pavement for a new gig. Low unemployment is usually a good sign. It means businesses are booming, people are earning, and the economy is chugging along nicely. This positive vibe can boost a currency, making it more attractive to investors. But hold up, high unemployment is a whole different ballgame. It can signal a struggling economy, shaky consumer confidence, and a whole lot of uncertainty. This can make investors hit the panic button, dumping the currency and sending it on a downward spiral. Now let's talk about inflation, the sneaky party pooper that can erode your purchasing power faster than you can say hyperinflation. In a nutshell, inflation is a rise in the general price level of goods and services. It means your hard-earned cash doesn't stretch as far as it used to. A little bit of inflation is normal, like a gentle breeze on a summer day, but when inflation gets out of control, it's like a Category 5 hurricane ripping through your wallet. High inflation can wreak havoc on a currency, making it less desirable to hold and potentially leading to a depreciation death spiral. Section 5, Real-World Smackdown, when news makes currencies wobble. Okay, enough with the theory. Let's get down to some real-world smackdowns. Remember that time when the US economy posted unexpectedly strong job growth? The US dollar shot up like a rocket, leaving other currencies eating its dust. Or how about when a certain European country, let's just say it rhymes with Greece, was teetering on the brink of financial meltdown? The euro took a nosedive, leaving investors scrambling for cover. These real-world examples show just how much economic indicators can pack a punch in the Forex market. Section 6, the ripple effect, how one indicator can rock the whole boat. Imagine the financial market as a vast ocean, where every wave and ripple can affect the entire ecosystem. Here's the thing about economic indicators. They are like the currents and tides of this ocean. They're all connected, like a giant game of financial dominoes. Each piece represents a different aspect of the economy, such as GDP, inflation, employment rates, and consumer confidence. One indicator can set off a chain reaction that impacts other indicators and sends shock waves through the entire Forex market. For instance, a change in employment rates can influence consumer spending, which in turn affects business revenues and stock prices. For example, a surge in oil prices, not strictly an economic indicator but still a major player, can fuel inflation, leading to higher costs for goods and services, which can then force central banks to raise interest rates, aiming to control the inflation and stabilize the economy, which can then impact economic growth, as higher interest rates can slow down borrowing and spending, and so on and so forth. It's a wild ride, with ups and downs that can be as unpredictable as a roller coaster. But understanding these connections can give you a serious edge in the Forex game. By keeping an eye on key indicators and understanding their potential ripple effects, traders can make more informed decisions and navigate the financial waters more effectively. So the next time you see a report on an economic indicator, remember that it's not just a number. It's a signal that can set off a series of events, rocking the whole financial boat. Stay vigilant, stay informed, and you'll be better prepared to weather any storm that comes your way in the Forex market. Section 7, don't be a Forex fool. Why indicators matter. So why should you care about all this economic mumbo-jumbo? Well, my friend, understanding economic indicators is like having X-ray vision into the Forex market. It helps you make informed trading decisions, spot potential opportunities, and avoid getting caught with your pants down when the market takes an unexpected turn. Remember, knowledge is power, and in the world of Forex, economic indicators are the keys to the kingdom. Section 8, Indicator Overload, keeping your head above water. Now, before you dive headfirst into the world of economic indicators, a word of caution. It's easy to get overwhelmed by the sheer volume of data out there. There are literally hundreds of economic indicators, each with their own quirks and nuances. Don't try to be a hero and track every single one. Start by focusing on the major indicators: GDP, unemployment, inflation, interest rates, and trade balances. Once you've got a handle on those, you can start exploring other indicators that are relevant to your trading strategy. Section 9, Tools of the Trade. Where to find your economic intel. Luckily, you don't need to be a Wall Street whiz kid to access this valuable information. There are tons of resources available online and through trading platforms that provide economic calendars, real-time data releases, and expert analysis. Some popular websites include Bloomberg, Investing.com, and Forex Factory. Many trading platforms also have built-in economic calendars and news feeds. Section 10, From Indicator Insight to Forex Fortune, Putting Knowledge into Action. So, you've got the knowledge, you've got the tools. Now it's time to put it all together and start making some informed trading decisions. Remember, economic indicators are just one piece of the puzzle. You also need to consider other factors like technical analysis, market sentiment, and risk management. Start by identifying a few key currency pairs that you're interested in trading. Then, track the economic indicators for those countries closely. Look for trends, discrepancies, and surprises that could create trading opportunities. Section 11, the final word. Stay sharp, stay informed, and keep on trading. The Forex market is a dynamic and ever-changing beast, but by understanding the language of economic indicators, you can gain a significant edge and increase your chances of success. So stay sharp, stay informed, and keep on trading.